Just got back from a business trip in San Antonio. Cool city, but we got to figure out what we do about bond investing. Come on. This place is crazy.
Every singer needs a song.
Hey, before we get started here, I want you to go to this link below and check this out after the show. Stacking Benjamin's podcast, which is an amazing podcast that fuses entertainment and personal finance. They're taking the show on the road in Orlando, Kansas City, and Detroit in September 2018. I'm going to try to be to 2 of those shows. You should check them out if you want to have a fun evening, a personal finance twist. Now, our question today comes from Luce, and look at the kind of questions I get. That is some detail, and it shows how important these subjects are and how motivated people are, not just to survive retirement, but to really rock retirement. So Luce is going to retire in 2019. Her mom had a long-term illness. She had always talked about traveling in retirement, got sick. Luce helped take care of her for 15 years, and then she ultimately passed away. And I can relate to that, Luce, and I'm sorry to hear that. My mom passed away at age 48, having all these dreams for retirement too, and it's definitely flavored a lot of my message in, hey, we gotta live well today and still be okay tomorrow. We can't just always postpone. But her main question is really focused on bonds. Her portfolio is about 90% in equities and 10% in bonds because she's been accumulating assets for all these years. And that makes sense. She's real volatile, and no doubt it's likely paid off for her given how markets have been. But she knows that she's leaving accumulation and she's entering a different phase of her life, which is going to require a different way of investing to minimize the volatility of her investment assets. Well, in portfolio theory, typically what that means is you increase the amount of bonds you have in your portfolio and you decrease stocks, because bonds historically are a lot less volatile. They don't move around everywhere. And Luz is concerned about this because her bond portfolio in these index-based mutual funds that she has recently haven't really been doing that well. And wow, I want to take, if I go from 90% in stocks to 60% in stocks, and I add 30% more to bonds, and they're not really doing that well, that doesn't seem like it makes sense to her, and she's wondering, what do I do here? Well, the Bloomberg Barclays Aggregate Index, which is like the S&P 500 in stocks, it represents the swath of the bond market. Now, hey, let's not forget, you can't actually invest in an index, only things that mimic indexes. Different types of investments have various degrees of risk, and past performance is no guarantee of future results. Okay. Well, the Barclays Aggregate Index is down about 1.6% for the year. Currently, if you look at it in August of 2018, it has what's called an SEC yield, so it's paying interest of about just over 3%. Which has been going up because the Federal Reserve has been raising interest rates. Well, raising interest rates is a two-edged sword when it comes to bonds. It's good because the interest that you get in your money market, your savings account, any new bonds that are issued are going to be higher than they were before. Where it can be bad, though, is on the short term, is the bonds that you own will go down in order to make the interest rate that it's paying on par with what the market rates are. And so that's why, a big reason why we're seeing the bond index go down some is because the Fed has been increasing interest rates. So if you move a bunch of your money to bond portfolios during an increase in interest rates, you could easily see your value go down. Now, when it comes to modern portfolio theory and asset allocation, that all works out in the end, right? Because it's constantly rebalanced and churning. The hard part is that science of asset allocation only takes you so far, right? Because it's based on statistics over a very long period of time, and you don't live in that long of a period of time. Lose, and you, if you're close to retirement, you care about the particular season when it's most important to you. And seasons can be very different than averages. We see that in temperatures where you live, but we also see it in investment portfolios, right? The average return may work out in the end, but you can have seasons where it's a lot colder or a lot hotter. So when we look at bonds, when we've had the Fed increasing interest rates and projecting or forecasting that they're going to continue to increase interest rates, what do you do if you're supposed to have technically 40% of your portfolio in bonds? That will go down if interest rates go up, even if it all works out in the end. Well, first off, let's gauge how much risk there is in bond interest rates going up to a portfolio. And we'll just use the index, the Barclays aggregate. The rule of thumb in bond portfolio management is you look at the effective duration of the portfolio. And not to get too technical here, but the effective duration is basically the average maturity of the bonds in the portfolio adjusted for the timing of cash flows. So if we look at the Barclays aggregate index, it has an effective duration of 5.79 years. I put percentage, but it's years. 5.8 years, we'll call it. The rule of thumb is in investment management is if interest rates move up by 1%, a bond portfolio will go down by the amount of its duration. So if we look at the Barclays aggregate index, if interest rates go up by 1% from here, in theory, the Barclays aggregate portfolio or anything mimicking it would go down by 5.79%. That's a lot, right? Especially when you're only getting a 3% yield. You can see how if we have interest rates go up by 1% from here, how it could all be wiped out and you could actually be at a loss in the short term. It doesn't seem like it's a great deal, right? Especially if we're forecasting that interest rates are going to go up over the next year or two, barring, the economy slowing down or some other external shock. So what do you do in this period of change in the bond markets? Well, number one is you can just believe the science of asset allocation. Buy your bond allocation in your flavor of choice of vehicle and bet on the long-term averages. Or you can say, hey, I get the science of asset allocation, but we need to have some art here too, so I can straddle the fence between I'll buy a portion of the bond allocation and then I'll use some alternative things that may protect the price value of my safe assets during this period of change. And so what could be some things that you use during this time of change? Well, you could use an insured cash account in your 401k. A lot of times they're going to have yields close to what the index is yielding, or 2 to 3%, so you give up some yield, but you get price safety. You could use CDs as part of your bond allocation because that, I think I looked online, I saw a 13-month CD for 2.25%. So that's giving you over 2/3 of the yield that the Lehman aggregate has, the Barclays aggregate, and no price risk. Right? It's just that risk of the bank, but that's FDIC insured. Or you see online money markets that are yielding as high, I think I saw one at 1.85%, which is over half the yield of the index without any price risk, but it will move, from an interest rate standpoint. So as interest rates increase, that yield could go up, fairly quickly. Those are some basic alternatives that you could use, Luce, or anybody, as part of your bond portfolio during the season of change, with the idea that as we get through this series of this season of change with interest rates and we get to quote unquote normal, then you can stop being tactical with that portion of your bond portfolio and just put it into whatever vehicles you want to execute that bond portfolio. I think the key here is you want to have a basis for the process and how you allocate this bond portion, because otherwise you're just making decisions willy or nilly. And I think asset allocation is a very solid foundation for allocating assets. But I think you need to meld the art of portfolio management, some of the midterm tactical stuff, with the science of asset allocation to hopefully get you to a better solution. I hope that helps, and I hope you rock retirement.